Hi friends, welcome to the channel JV and CIV Made Simple. So this is our theory of AVFM unit number 7 and the chapter name is Sources of Finance and Financial Strategy, and this is the first chapter of module B of AVFM. So let's first see what are the topic which we have to study in this particular chapter. We will see the objective, we will see the introduction, equity capital, internal accrual, preferential capital, term loan, debenture and alternative financial strategy in the context of regulatory requirement. So there are 7 topics which we have to go through. So let's start with the first topic, that is our introduction to the business finance. So friends, imagine you are starting a business, let's say a coffee shop. You need money for rent, furniture, coffee machine, salary before you even sell your first cup. This starting money is what you call as initial capital, right? So you need, before selling your first cup, you need the money for cup and coffee machine and for salaries, furniture, rent. So this is called initial capital, right? The money which you need initially is called initial capital, usually bought in by the owners, right? Usually bought by the owners or promoters, right? Now, but what if business is a big, like a factory or shopping mall? Then apart from personal fund, business take long term loan, right? So business take long term loan, right, from bank to set things up. Now even after business is running, daily expense like buying a stock, paying staff, managing bill, they need working capital, right? So they need something called working capital, right? So this is the money that keeps things moving. Think of it like fuel for your business engine. Bank help business manage this by funding the gap between what the company own, that is called asset, and what it owes, that is called liability. But they don't give free money. Business have to contribute their share also, right? So the three things which we have just talked now, first of all you need the initial capital. You can see they require finance to establish and to operate. So initial fund they provided by owner or promoter. Then for large project, like suppose we have some shopping malls, or suppose we have some factories, right, that they need long term borrowing, right? They need to manage bills, sorry, they take long term loans. Apart from personal fund, they need long term loans from bank to set the thing up, right? And then after the business is running, some daily expense is likely there, right, like buying a stock, paying staff, managing bills, and all these things are taken care by the working capital. So these factories or these shopping malls need something called working capital, right? So this is the money that keeps things moving, that is called current operational cost, right? So how it is decided? This is basically the gap between assets and liability, which is funded by the bank, right? So bank help business manage this fund by funding the gap between assets and liability, but they don't give free, they demand borrower contribution. That is the key point, that business have to contribute their share also. While giving working capital finance, bank don't give everything free, right? They also want borrower contribution. Now the next question is how much money flow in a business. Let's talk about this so called operational cycle. So the question we are asking is how much money in a business, how much money flows in a business, that is called operating cycle. Let's break it down. A business invests in raw material, turn them into finished product, sell them and collect payment, right? So what are the steps? Let me see. So first of all, raw material, from raw material they turns them into finished product, right? After finished product they collect payment, after finished product they sell them, and after selling them they collect payment. These are the steps involved: raw material, finished product, selling and payment collection. So this whole cycle from spending money to earning it back is called the operating cycle. Raw material, finished product, receivable means once they have finished their product they will sell them, and after selling they will collect the payment. This is called receivable. So this whole cycle from raw material to from spending money, right? In raw material obviously this particular factory has spent its money, so this whole cycle from spending the money to getting the money back is called operating cycle. The faster this cycle move, the better the business perform financially, right? So the faster this operating cycle move, the better the business perform financially. Now there is something called smart financial strategies for success. So what is this financial strategy? Every business want to reduce cost and increase profit, right? So the main motto is that the main motive is that cost reduction and profit increment. Every business want it, right? So how do they do it? So first thing they do have the clean finance. Try to understand. So money is raised without giving any collateral. What is the meaning of clean finance? Money raised without giving any collateral, like selling share or issuing unsecured bond. But since there is no guarantee for lender, they charge higher interest rate, right? So this is called clean finance. So what we are basically discussing, that every business want to reduce the cost and increase profit. So one way to do this is to clean finance. You don't ask for any collateral. What is the collateral? Like equity, preference share. You don't ask for any kind of collateral, like selling share or issuing unsecured bond. But since there is no guarantee for lender, obviously since collateral is not taken, obviously there is no guarantee for lender, so interest rate is kept high. That is called high cost, obviously. So there are some drawback also, there are some advantages also, that you need not to give collateral, but since you are not giving collateral, so you will be charged higher interest rate. So that is what we call clean financing. The second way to have low cost and high profit is secured borrowing. What it means? Here business offers some security, right? Offer some security like property. The business offer property, or the business offer something called asset, right, to banks, which lower interest rate. So since they are offering something, so obviously the interest rate will come down, right? So a company financial health and credit rating also impact the borrowing cost. So what we learned from this discussion is that a smart business balance long-term fund. You can see a smart business balance long-term fund for big investment and short-term fund for daily operation. Two things. Smart businesses balance long-term fund for big investment. So they have to invest big, they will take long-term fund, and they will take short-term fund for daily operation, like working capital we just talked about. The trick is to use a mix of equity. You know equity? Equity means ownership money. The trick is to use a mix of equity and debt. Debt means borrowing, right? The trick is to use a mix of equity and debt wisely, keeping cost low and profit high. This is the main trick. So obviously business can't survive without taking long-term loan or without taking short-term loan. Long-term loan is needed for big investment. Short-term loan is needed for daily operation in the form of working capital, right? So they can but what they need to do, the trick is to use mix of equity. Means they should have the ownership, and also they should take debt to optimize cost and benefit, to maximize profit and minimize the cost, right? So hope that make business finance super easy for you. I hope you find it helpful. Do like the button, do hit the like button, drop a comment and subscribe for more simplified CIIB content. Now let's discuss the next part, that is our equity capital. Now that you know the basics of business finance, right? So let's discuss now equity capital. So friends, what is equity capital? Think of it like this. You can think of the equity capital like this. Imagine you are starting a business, right? So first of all, let me tell you a story to make this equity capital more clear. So suppose you are starting a business, fine. Let's say a food delivery app. So let's say you are starting a business of a food delivery app, fine. You need money to develop the app, hire staff, market your service. Now where does this money come from? Obviously you will need money to you need staff to hire, you need you need market, you need staff to market your services, right? You need app, so app developer. So where does this money come from? For all this you require money. How to secure this money? So this is where the founder or the promoter, so you will see this term, the promoter, or we can call it the founder. The founder or the promoter put in their own fund, and this is what is called equity capital. So the founder or promoter put in their own fund, means whoever has founded this food app, they will put their own fund, and this is what we call equity capital. Think of it as the backbone of a business. It is the owner money invested to kick start the operation, right? So what it is all about? It is the owner money invested to kick start the operation, right? So that is amount invested by owner, amount invested by promoters to start a business, right? So this is what we call owner money invested to start an operation, right? So it is the owner money invested to start operation. Now the question is how equity work. Let's understand it. Let's understand the basic behind the working of an equity. So you know there is something called units, or either you call it unit or you call it share. Both means the same, right? So there is something we can call it unit or you can call it share. So what is the meaning of so-called unit? So friends, you know that equity capital is divided into a small unit which we call as equity shares, right? So you can see this term written here, equity shares. Equity capital is divided into a small unit which is called equity share, like teeny piece of the company. You can think of the piece of the company, right? Piece of a company. Okay, so when you buy a share, you own a small part of the company. When you buy equity share, you own a small part of the company, right? So this equity capital is divided into a small unit which we call equity share. So suppose, let me make a picture to make it more clear to you. So you think of this like an equity capital. It is divided into many teeny pieces. Many pieces are there in it, and each pieces is called equity. Or you can think of like this. Suppose I take a square. I make a square here. I divide it into many small parts. So each of this part is called what we call as equity share, and this entire is called equity capital. So this equity capital is divided into a small unit, and each small unit is called equity share, right? So when you buy a share, it means you own a small part of the company. Now what are the financial benefit of acquiring the equity share or acquiring equity share? Let's understand what is the financial right you have. So shareholder get dividend, right? You will get dividend. What is the meaning of dividend? Dividend means the share of profit. When I say dividend, I mean to say you get share of profit, right? You get share of profit. So, and if the company ever shut down, they also get a part of the leftover asset. Under liquidation, you know that in the case of liquidation, right, if the company is going to shut down, so this shareholder, they get a part of the leftover asset. Whatever asset is left off, they will get the part. So that is the financial right of shareholder, right? Is it clear? So first of all, so there are two benefits we have just talked now. First of all, they will get dividend. Dividend means what? A share of the profit, whatever profit the company has earned, right? The shareholder will get a part of that, which is called dividend. And when the company is in liquidation, the shareholder gets part of the leftover right. And there is something called voting right. You see, there is something called voting right. What it means? That voting right, the shareholder have voting right to decide the company's future. So these are the three benefits we have just talked now. Let me remind you. The first is they get dividend. The second thing they get is leftover asset in case company goes into liquidation. Third thing they get is the voting right. So these are the financial right available to the equity holder. Now the question is, who can buy share? Who can buy share? Let's answer this question. So equity share are open to anyone who meet the company's rule. So anyone who meet the company's rule. And what is the company rule? It is called AOA. AOA means article of association. That is called company rule. So whoever meet the company rule, he can buy the share, right? If you have heard of IPO, have you heard of this IPO? IPO is called initial public offering. So that is when a company sell its share to the public for the first time. So under IPO, what happened? The company sell its share to the public for the first time. This is called initial public offering, right? Now there is something called control and rule. You know, shareholder follow the company rule book, and the company rule book is called memorandum of association, an article of association, which ensures that fairness in the decision making, right? So the rule is governed by shareholder follow the company rule book, and there are two rule book, MOA, we call it MOA, and we call it AOA. MOA means memorandum of association, AOA means article of association, right? So these are the rule book which ensures fairness in decision making, right? So I hope you understand what is the rule book which ensure fairness in decision making. Then we have something called selling share. Now suppose someone want to sell share, right? That is called exit option. We also call it exit option, or we call it selling share. How to do that? You know that want to sell your share, no problem. Shareholder can exit anytime by following the set process. If the company's share are listed on a stock exchange, you can sell them easily. So suppose the company's share is listed on a stock exchange, so you can sell them quite easily. Now let's talk about the market value and pricing, that is liquidity and pricing. Let's talk about it. So friends, you know, share can be issued at their original price, right? So share can be issued at their nominal value, or we can call it the original price, right? A higher price, or even at a discount based on the regulation. So regulation decide the pricing, right? So the pricing of share is decided by the regulation. So I told you the three prices. The first price is called nominal value, second is called premium, or a discount. Nominal value means what? Nominal value means original price. When I say nominal value, it means original price. When I say premium, it means higher price. When I say discount, it means lower price. Based on the regulation, they decide the pricing, right? So share can be issued at the original price, at the premium or discount depending on the regulation. And there is something called adjustability, which means flexibility. You know what it means? Equity is not fixed company. Equity is not fixed. Company can increase, reduce, split, buyback, or even issue free share, right? So when I say adjustability, what I mean to say is that flexibility. You know, equity is not fixed. Company can either enhance, it can increase it, it can decrease it, right? Or it can split it, subdivide it, or it can be it can buy back or even issue free share, and it can be issued for free depending on their financial need. This is called adjustability, or we call it flexibility. Then we have something called collateral, right? So collateral means borrowing against share. You know that you need a loan, you can place your equity share as collateral. If you need a loan, you can place your equity share as a collateral, right? Or even you can issue free share, right? So two things you can do: either you can place your equity share against collateral, or you can issue something called free share. So these two things you can do, right, depending on the financial need. So if you need a loan, you can place your equity share as collateral to borrow money, since they hold market value. Since your equity share has a market value, so you can place a collateral as place your equity share as collateral to borrow money, since they hold market value. So what we learned till now, that equity capital is like a fuel that start the business engine. So what it gives you? It gives you ownership. First thing it gives you ownership. Second thing it gives you voting power. Third thing it gives you financial return, right? It gives you something called financial return, right? And fourth thing, it gives you voting right, financial return, and flexibility while keeping the company running strong. So now let's talk about share capital as an essential topic for business and finance, right? So have you ever wondered how company raise money by selling share? So this slide will help you just to understand it in super simple way. So the first of all, we have to understand what is share capital, right? What is the meaning of this so-called share capital? You can think of it like this. Imagine you want to start a restaurant but don't have enough money. So you invite investor to put in fund in exchange for share of the business. So what is happening? You want to start a restaurant, right? But you don't have enough money. So what you do? You invite investor, right? You invite investor. Why you invite investor? You invite investor so that they put in fund in exchange for share of the business, right? So investor will put fund, and what they will get in return? They will get share of the business, right? So this is the importance of share capital. So the money raised by selling share is called share capital. What is happening? Investor you are inviting, right? So what investor will do? They will put the fund, they will give the fund, and what they will get in return? They will get share of the business, right? So this money raised by selling share. So basically what you are doing, suppose this is you, and this is the investor. So you are giving share to this investor, and investor is giving you the fund. So the money raised, the fund you are raising by selling this share, is what we call share capital. So now it is no more confusing word. Share capital just means what amount of money you have raised by selling your share. Now let's break it down into different types and simple. What are the different kinds of share capital? So the first type is called issued share capital. So friends, now let's first understand what is the meaning of this so-called issued share capital. So issued share capital is the portion of company's total capital that is actually offered to investor. So suppose this is the company's total capital. This is the company's total capital, and you know there is a portion of it. Suppose this portion which I have highlighted by this dash color. So this portion of it is offered to investor. So the portion of the share which is offered to investor, and this portion is what is called issued share capital. And what it includes? It includes shares sold for cash, right? It includes shares sold for cash, or it also includes share given to the promoter, right? Share given to the promoter, or display for sale, right? So share given to share which is sold for cash means you have taken the cash and you have sold the share, so that share is included in it. Second, it also include given to those share which is given to the promoter, right? So two types of share are included in the issued share capital. Now some people may buy So now you can think of it like a shop putting product on display for sale, right? So suppose a shop is there, and what this shop is doing, this shop is putting product. This shop is putting product on display for sale. Some people may buy, some may not buy, right? So that is what is happening. It includes share issued for cash and other consideration to promoter or other individuals, right? So this is called issued share capital. Then the second part is called subscribed share capital. What is the meaning of subscribed share capital? Means money that investor agree to pay, right? So let me make it more clear. What is the meaning of subscribed share capital? Just in a single word we can say money that investor agree to pay. Not everyone will buy all the share issued. So suppose this is the company total share. Say out of this much is the issued one, right? This much is the issued one. If we zoom into it, so now this is our issued share. You know what will happen? That not everyone will buy all the share issued. The amount actually subscribed by the investor is called subscribed share capital. So suppose only this much share is subscribed, only this much, which I am setting by red color, only this much share is subscribed out of this issued capital. So this pie chart shows issued capital, right? And out of the issued capital, this much part is left, which is in the blank. So the blank part is left, right? So some share might be bought with cash, while other could be issued in exchange for services or other asset, right? So what has happened, that not all shareholder may respond, right? So means now if we talk about how this share was issued, so this share was issued either in exchange for cash or in exchange for non-cash consideration, right? It means exchange for some services or other asset. So this is what we call subscribed share capital, means money that investor agree to pay. Then we have something called called up share capital. What it means? See, just because people agree to buy share does not mean the company collect all the money at once. People agree to buy share does not mean that company collect all the money at once. Instead, it asks for payment in stages. So here is the key point. The company asks for payment in stages, right? So just because people agree to buy share does not mean that company collect all the money at once. Rather, company asks for payment in a stage, and the portion that company calls up is called called up share capital, right? So the basically all the shareholder have agreed that yes, I will pay you the money and you give me the share. But it does not like that company collect all the money at once. The company collect money in stages, just like EMI. You know about EMI, equated monthly installment. Just like bank give you a loan and collect money in form of EMI, similarly company collect the cash or consideration for the share in different parts or in stages, and the portion that company calls up is called called up share capital, just like EMI plan for buying share. Suppose there is an EMI plan for buying share, that is called called up capital, means money asked from investor, right? That is called called up. Fine. Then the next point is paid up share capital. This is also part of share capital. What is the meaning of paid up share capital? Not all investors pay on time. The amount that shareholder have actually paid is called, as the name itself suggests, that it is not like that suppose you are giving EMI to the bank. Sometimes it happens that you default on EMI, you do not pay EMI on time. Similarly, what is happening here also, that a shareholder they have to pay the call in value, but they are not able to pay, right? So that is called, means the amount that they have actually paid is called paid up share capital, right? So if some investor delays payment, the subscribed amount may be higher than the paid up amount. Obviously, if some investor delays payment, so subscribed amount will be higher than the paid up amount, because what are the subscribed amount? Subscribed amount is the amount that they agree to pay, but paid up amount is the amount that they have already paid only. Means since subscribed amount is higher, it means that they have not paid in full, right? That is what it means. Now there is something called call in arrears. So what do you mean by call in arrears? That if this is called pending payment. So this pending payment is what we call as call in arrear, right? So if some shareholder don't pay on time, the spending amount is called call in arrear. The company has the right to collect this from the investor. Obviously the company has a right to collect this pending payment from the investor, just like bank remind you about a missed EMI. Suppose you missed paying an EMI, so bank remind you. Similarly, company has a right to collect this called in arrear, means the amount which the company has not paid, which the shareholder has not paid, right? And then we have something called unpaid share capital, right? So you must understand all these terms, super important. Now what is the meaning of this so called unpaid share capital? Let's try to understand it. Here is the term unpaid share capital. You know, the amount is still due. The amount is still due. So if shareholder fail to pay even after reminder, this become unpaid share capital. Means bank has reminded, the company can take legal action or set rule for payment recovery. So company has issued the share, but it has not received the payment despite multiple reminder to the borrower or to the shareholder, but the shareholder is not paying it. And so this is called unpaid share capital. Means if shareholder fail to pay even after reminders, this become unpaid share capital, and the company can take appropriate action, or the company can take legal action or set rule for payment recovery. And then finally we have something called forfeited share. What is forfeited share? As a last resort, if someone does not pay even after multiple reminder, the company can cancel or forfeit their share. So this is the lender of the last resort, we call it as a last resort, right? If the particular as a last resort, you know, if someone does not pay even after multiple reminder, the company can cancel or forfeit their share and sell them to someone else. So think of it like losing your gym membership if you don't pay your monthly fee. So what we learned from this discussion is that share capital is how business raise money from investor by selling ownership. So basically when the company is selling share, what it means, that company is selling ownership, right? So it comes in different stages, from offering share to collecting payment. I hope it is clear. So we have talked about what is the meaning of issued share, what is the meaning of subscribed share, what is the meaning of called in capital, paid share capital, unpaid share capital, call in arrear, right? Then we have discussed the so these are the different kinds of share, which is from issuing to offering to the payment collection, right? These are the different types. Now very important question which we are going to discuss now, super important. Let's try to understand. So friends, if you are confused about what is the difference between why choose equity capital over long term loan, right? If you are confused about whether business should raise money through equity or taking a loan, I told you earlier that there should be mix of these two, right? But if a business should raise money through equity or loan, you are confused, so this slide will make you clear. So question is equity capital versus long term loan, right? What's the difference? Think of it like running a startup. Suppose you are running a startup, you know that you need money to grow, right? You are running a startup, you need money to grow, but where should it come from? Where should the money come from? Is it from equity capital, or is it from you have two choices, right? So first choice you have is the equity capital, right? So it means selling a piece of your business to investor. So basically what you are doing, you are selling a piece of your business to where? To investor. This is called equity capital. And the second part is called long term loan. Long term loan means what? Borrow money from a bank and pay it back with the interest, right? If you talk about the long term loan, it means you borrow money from the bank, right, and pay it back with the interest. That is called long term loan, right? So you have two choice, we know it. So why do company often prefer equity capital? Let's find out. Right, so let's talk about the why choose equity over the loan. Let's answer this question. What are the big advantage? The big advantage is that no fixed payment, right? First thing is that no fixed payment. Let me write it down. No fixed payment. What it means? It means that unlike loan where you have to pay interest regularly, equity holder don't need to be paid a fixed return unless the company make a profit, right? So means in loan what happened, that you have to pay interest regularly like EMI, but equity holder don't need to be paid a fixed return until the company make profit, right? So until the company makes profit, you need not to pay anything to the equity holder, right? Second, no repayment stress. Means what? Loans need to be repaid no matter what, even if the company struggle, but with equity there is no repayment obligation, right? So this is one of the major advantage. The third advantage is that risk capital without debt. So it provides you risk capital without debt. What it means? It means raising money through equity provide risk capital. If you raise money through equity, obviously it will provide risk capital. What is the meaning of risk capital? Risk capital means which means company get the fund they need. When I talk about risk capital, it means company get the fund they need, right? So company get the fund they need without worrying about fixed interest payment. So that is called risk capital. So it provides essential risk capital without debt, So company get the fund they need without worrying about fixed interest payment. Then we have ownership and growth. So this is another importance of equity capital. That means equity investor become part owner, making them more invested in the company's success. This boosts confidence and attract more lender. Obviously, since they become part owner, so this boosts their confidence and attract more lender who see a strong equity base as a sign of financial stability. Sounds great, right? But wait, there is a flip side too. So obviously these are the advantages, like let me remind you, no fixed payment, no repayment stress, risk capital without debt, company get the fund they need without worrying about fixed interest payment, ownership and growth, right? So equity investor become part owner, making them more invested in the company success. So this boosts confidence and attract more lender who see a strong equity base as a sign of financial stability. But there are some challenges also. So let's talk about the hidden cost. Let's talk about the drawbacks now, right? So here it is. You know that investor expect more profit. Yes, those who invest, they expect more profit. Obviously this is their expectation. So investor expect more profit. Since equity holder take more risk, they expect higher return, making it more expensive for company in the long run. In the long run it is more expensive. Why? Because you know, since someone who is investing, he is taking risk, so they want high return, because you know risk and return are proportionate, right? Higher the risk, higher the return. Now you know raising equity is costly. Raising equity fund is expensive. Selling share involve advertising, printing, brokerage fee, legal compliance, which can add up the cost. So this is the two disadvantages of it. So, and also you know there are some tax disadvantage also. Alright, so let's talk about tax disadvantage here. So one thing is costly, we have just discussed now. You know, tax disadvantage. Unlike loan interest, which reduce tax liability, dividend paid to the shareholder come from post-tax profit, making equity costlier than debt in some cases. Right? So here it is the point, real cost of servicing equity. So basically what is happening here, this is called tax disadvantage. Right, this is called tax disadvantage. Unlike loan interest, so if you take loan, we are comparing loan versus equity, that is what we are doing. So if you take loan, right, which reduce tax liability, obviously you take loan, it will reduce your tax liability. Like you take home loan, then you have to, that particular interest which you pay is deductible under the old tax scheme, you know it very well. So unlike loan interest which reduce tax liability, dividend paid to the shareholder. So some shareholder means the investor, he is getting the dividend. So this dividend is not anyway reducing the tax liability to the, because it come from post tax profit, which make equity costlier than debt in some cases. Right, so dividend paid to equity will come from post tax profit. This make the actual cost of servicing equity higher than the debt. Now there is one thing also, there is another one disadvantage, which is called dilution of ownership, which means what? Which means loss of control. So when I talk about dilution of ownership, it means loss of control. So what it means, loss of control? It means that unlike loan interest, more investor means less personal control. Right, obviously if there are more investor, it means what? It means they have the control. We talked about the voting right which is given to the investors of the share or the shareholder. We know what is voting right. So if there are more investor, it simply means that there is a less personal control. Right, there is a less personal control over the business. So raising equity means sharing decision making power with more and more people. Right, so final takeaway, which one should a business choose? So depending on the what they need. So suppose a business want financial stability. If business want financial stability and business want long-term growth, if business want financial stability and it want long-term growth, equity is a great option. While if they want to retain control and lower cost, because cost is higher, if they want to lower the cost and retain control, then debt loan may be better. So the smartest approach is that a balanced mix of both, using equity for stability and loan for expansion at the low cost. Right, stability is there in equity and loan for expansion at the low cost. So this mix is very important. So I hope this simplified equity versus loan capital for you. I hope if you find this helpful, please hit the like button. Now let's talk about the internal accrual here. Right, so let's talk about one point, now let's talk about the internal accrual. Have you ever wondered why company don't distribute all their profit to shareholder? So this is company, right? These are the shareholder. What company do? They don't distribute all their profit, right? The company don't distribute all their profit to shareholder. Why so? Let's understand. So, and what will happen to the money they hold back? And is it actually a good thing? Right? So let's break it down in the simplest way. Let's answer this question. Let's find answer to this question in the upcoming slide. Right? The question is what? That why don't company offer all their profit to shareholder? Why don't company distribute all their profit to shareholder? And what happened to the money they hold back, which is called retained earning? And is it actually a good thing? Let's answer it. So the first question: why don't company give away all their profit? Imagine you get your salary. Let me take your example. Imagine you get your salary. Do you spend every penny immediately? Probably not. You save a part of it for future need, isn't it? You save a part of it for future need, right? So company do the same. That is called profit after tax. That is called PAT, right? Is like the company's salary, but instead of distributing everything to the shareholder as dividend, a portion is kept for the financial stability, right? A portion of PAT the company keep for financial stability. The main purpose is what we call financial stability, right? So this is the internal accrual. This is also called this financial stability. The portion which is kept is also called what we call internal accrual, right? So this is called internal accrual. Basically the money the company save from its profit. I hope now it is clear what is the meaning of internal accrual. Now the next question is, right, so now I hope you understand why don't company distribute all its profit among the investor? Because it want financial stability, and financial stability they need to save some money, and that particular money is what we call internal accrual. Now the next pertinent question is, where does this money come from? What is the source of this internal accrual? Well, where does this money come from? So company build their internal saving from different sources. The first source is the PAT. What is the PAT? Profit after tax, means the actual earning after paying taxes. The second source is the non-cash profit. What is the meaning of non-cash profit? So it means like provisions, like reserves. There are some emergency fund which is set aside. In banking also provisioning is done, so company also do some provisioning, emergency fund. So these are kind of emergency fund that is set aside. So this is also a source of internal accrual for financial stability. And depreciation, a smart way to reduce tax liability while increasing cash reserve, but does not directly boost general reserve. So let's make it more clear. What is the meaning of depreciation? Right. So when I mean that depreciation increase cash balance but does not affect general reserve. So what is depreciation? Depreciation means the reduction in the value of an asset over the time, like when a machine or building get older and lose their value. But here is an interesting part, that while reduction in value is a loss on paper, obviously something value is reducing, it is obviously a loss. Loss on what? Loss on paper, right? It is a loss on paper. But it actually does not cost the company any cash right away. So when a company calculates depreciation, it reduces the value of asset on its balance sheet. This paper loss lower its taxable income, meaning the company pay less tax. Obviously, when because of depreciation, the company reduces the value of asset on its balance sheet. So this paper loss lower its taxable income, which means the company paid less tax. So what is the cash impact? Although depreciation lower tax payment, it does not require actual cash outflow. That is the important part of depreciation, right? So that is why. So that means in the end the company save cash, isn't it? So this save cash can be used for other purpose, like investing in new project or paying low debt, right? But what about general reserve? But what about the general reserve? Even though depreciation boosts cash flow, it does not directly increase the company general reserve. Instead, it simply adds to the cash balance without affecting the reserve. So this way, depreciation helps the company save money now, even though it is a non-cash expense. Depreciation is a non-cash expense. It is a clever trick to save on tax without spending actual money. So I hope this is clear now, how depreciation is a source of internal accrual, how it saves company cash, how it saves company money, because it is recorded just on paper. It is not actually something that company is paying, right? So it helps the company to save tax liability. So I hope the source is clear. So these funds stay within the company, helping the company grow and stay financially strong. Now then we have some other reserves in the form of so-called special reserves. So let's make it more clear. What are these special reserves? Some profit are stored in special reserves, like you see dividend equalization reserve, right? And the second is redemption reserve fund. right? So what are these used for? So there are two things which are talking about: dividend equalization reserve and redemption reserve fund. So let's discuss it. So this is called DER. Let us talk a little bit about it. This DER is like this reserve is like a rainy day fund for dividend. You know what is the meaning of this so-called rainy day fund? Let's talk about it. You know that company created to ensure that they can pay consistent dividend to shareholder even if their profit fluctuate. Imagine a company that has a great year and make a lot of money. It can pay out a big dividend to shareholder. But what if the next year is not as profitable? So the company might still want to pay a good dividend. So it uses something called DER, which is called dividend equalization reserve, to stop up the payment. So this reserve is smoothen out the dividend payment, ensuring shareholder receive a stable income regardless of the company profit swing. And there is something called redemption reserve fund. What it means? Redemption reserve fund is linked to prepare for future debt repayment. So it is linked to prepare the company for future debt repayment. So it's like saving account that company builds to pay off bonds or other long-term debt when they become due. For example, when a company issue bond, that is loan from investor, they take loan from the investor. So when a company issue bond, it agree to pay back the money after a certain period. So the redemption reserve fund help the company save up and ensure that it has enough cash to repay the debt when the time comes. So this reserve ensure that company won't run into trouble paying off its debt and help maintain financial stability. So I hope this concept is also clear regarding these two, DER and redemption reserve fund. Right, very nice. So friends, you know, these are some special reserves. So some profit are stored in special reserves like DER, like redemption reserve fund, but there is a rule. The rule is that these reserves can't be freely used until certain conditions are met, right? So you cannot freely use these reserves provided certain conditions are met, and we will talk about this condition later. So basically, what are the advantages of this internal accrual? Why this is a good thing? Yes, obviously it is a good thing. Why this is a good thing? Because keeping profit within the company has a big advantage, that there is a no restriction on use, right? Except for the special reserve. Except for the special reserve, we have just talked now like redemption reserves, just not talk now redeemable reserves. Except for these things, there is no restriction on use. Second thing is that it is useful for both long-term and short-term purpose. Third thing is that there is no borrowing cost, right? It is free money. Like you save from depreciation, you save from PAT after PAT. It is free reserves and it is easily available. It is liquid, and also there is no impact on ownership. Control stay with the existing shareholder, and no fundraising hassle. So these are the advantages. Sounds great, but wait, there is another side to this. There are some disadvantages also. Like easy money, easy to misuse also, right? Because since these funds are readily available, they might be used recklessly, and you know, shareholder might suffer. Sometimes what happen, this shareholder might suffer. You know how? These retained earnings are technically undistributed dividend. Obviously, these are the dividend which are undistributed, right? Undistributed dividend. So meaning shareholder, especially a small investor, may feel cheated, and you know, public investment might drop, reducing public investment interest. Why? Because you know, if a company does not have good dividend track record, investor may lose interest and they will not subscribe to the equity capital which the company raising it. So these are the disadvantages of having the accrued capital. I hope it is clear now. Now let's talk about the potential drawback of retained earning. That is what we call retained earning, right? So what are the drawback of this retained earning? Let's discuss it in simplest way possible. So friends, we are tracking two main topics, that retained earning and preference capital. So first of all, is it always a good idea of having retained earning? Imagine you have a saving account, and instead of using it only for emergency, you start spending it on random thing. That is exactly what happens when company use up their retained earning without thinking ahead, right? So if you start using your retained earning, if company start using retained earning, what will happen? So the key drawback of retained earning is that reducing financial cushion, right? So financial cushion reduce. It means that retained earning are like company safety net, right? So if they keep using this fund, their financial backup will weaken, making them more vulnerable in the tough time. And also easy money, which means risky decision. Since retained earning don't come with loan restriction or investor scrutiny, management might spend it on unnecessary or risky projects that don't add real value. This can hurt equity holder in the long run. So while retained earning are useful, they need to be managed wisely. This is important part. Now let's talk about the preference capital. So now we know accrued capital what it is, what is the meaning of retained earning. Let's talk about so-called preferential capital. Ever heard of an investment that is safer than equity but riskier than debt? So let's say this is the debt, this is the equity, and there is an investment which lies between these two. This is safer than equity but riskier than debt. So that is called preference capital. This is called something we call preference capital. So let me break it down for you. What is preference capital? Preference capital is a type of investment where investors get higher priority than equity shareholder when it comes to dividend and liquidation money. So that is why the word preference is written, because they get preference over whom? Over equity shareholder, right? For what? For two things: dividend payment and liquidation proceed. So if company goes into liquidation, right, if company goes into liquidation, then they will get preference over the equity shareholder and also dividend payment, but they don't have as much control over the company as equity shareholder, because they are taking less risk, right? They will get less return. Equity shareholder is taking more risk, so they will get more return, but they will get early payment. Now, what are the key features of this preferential share? The first is that priority in liquidation as well as profit. We know it very well, right? So preferential shareholder get paid first before equity shareholder, whether it is dividend or in the case of company shutdown. And the next part is fixed dividend, which means predictable income. Since their dividend is fixed, so it means their income is also predictable, right? So they receive a fixed dividend rate, just like interest on loan, making it a stable investment for them. And there is another advantage, that dividend conditional on profit, means dividend only if there is a profit. But here is the catch: if company is not making profit, it won't pay dividend. There is no legal obligation like there is for loan repayment. Obviously, like an equity capital also this was there, right? Equity capital, it was also like there, because if company is not making any profit, the company will not pay any dividend to the preferential shareholder. And these are not tax friendly as in the equity capital, because that unlike loan interest will reduce tax, preference capital come after tax is deducted, making them less tax efficient. So this was the disadvantage of equity capital also, just now we have talked about. Similarly, there's a post tax dividend. So let's start with loan interest. When a company take a loan and pays interest, the best part is that interest paid is tax deductible. So that means the company can subtract the amount of interest it paid from its profit, means lowering its tax income. Let us make it more clear using an example, this taxable part. So let's say, imagine a company which make a profit of 1 lakh. Suppose a company make a profit of 1 lakh and it pay rupees 10,000 in interest. So the taxable income now become 90,000 instead of this 1 lakh. Why? Because this means less tax is paid, which is a huge benefit for business. But what about preference dividend? So they are paid to preference shareholder before regular equity dividend are distributed. They are a fixed amount. So this means the company cannot subtract the dividend payment from its profit while calculating the tax. So the company end up paying tax on the full amount of profit, even though it has paid dividend. So this is a problem for company, because taxable income stay high and high tax burden, right? So I hope this is clear, that post tax dividend benefit is also not available to the preferential shareholder, right? Then we have the next is cumulative preference share. What is the meaning of this so-called cumulative preference share? So let's talk about it. Let's talk about this, the cumulative preference share. So no dividend, no worry, means that if a company skip a dividend 1 year, these dividend don't lose out. Their dividend accumulate and must be paid later when profit allow. That is called cumulative preference share, right? If in a particular year the company does not pay dividend, so it will accumulate for the next year. That is the point. And renewable preference share expiry date, means company can't keep this share forever. As per the Companies Act 2013, they must be redeemed within 20 years, right? So this preference share company can't give for forever, rather they must be redeemed within 20 years, either from profit or by issuing fresh share, right? So company can't keep this share forever, because company is giving you share. Okay, so this is the part. So limiting voting right. Unlike equity shareholder, preference shareholder don't get full voting right unless the company skip dividend for 2 years straight, right? So means what? Unlike in what happened in equity shareholder, right? in equity shareholder, the equity shareholder get the full voting right, but this preference shareholder don't get full voting right unless the company. So if the company is give dividend for consecutive 2 year straight, then they get the voting right. If they are receiving dividend each and every year, so this preferential shareholder will not get any voting right. That is the point. And final thought, when should company use this thing? Retained earning are great for internal growth but can weaken financial security if overused, and preference capital give company a way to raise fund without losing control but come with a fixed cost. So the other question is, what are the reason for raising preferential capital? So the question is that what are the pros? Why do company prefer preference capital? Imagine you are a business owner and need long term fund for a big project, maybe a power plant or a highway. You have two choices: take a loan, but that comes with mandatory interest payment and possible risk of losing asset, and either you issue and you can issue equity share, but that means giving away control of your company. What is the middle ground? The middle ground is the preference capital. It is a great way to raise fund without the burden of loan or losing decision making power. So key reason company choose preference capital is that long term funding, right? Means what? Up to 20 years. It is perfect for long term project like infrastructure, where company need money for decades without worrying about immediate repayment. And there is a chance of raising. Means unlike public share issue that require advertisement, brokerage fee, compliance cost, preference share are often privately placed, making them a cheaper option. This was the major drawback of the equity capital, where you need to pay brokerage fee, where you need to pay advertisement and compliance cost. No such cost is incurred during the preference capital, and that is why it is cheaper to raise. Now, no forced dividend payment. This is the best part. Unlike loan, where interest must be paid, dividend on preference share are not compulsory. This is very important part. You do not need to pay dividend on the share necessary, right? Unless there is a cumulative preference. If it's not a cumulative preference share, you did not pay dividend, and you have predictable recurring cost. Means it is the better planning. Unlike equity share, where dividend fluctuate, preference share have a fixed dividend rate. So this is the key part, that the dividend rate is fixed. It cannot fluctuate. So company can plan their finance easily. So what are the advantages and disadvantages of the preference capital? Let's also understand it. So first of all, let's talk about the advantages. So it includes DER. This is called debt equity ratio. It improves the DER because since preference capital is counted as a part of the company net worth, it helps improve the company financial standing, making it easier to borrow more if needed, because this preference capital is a part of company net worth. So this enhances the DER. Okay. Now, because this equity part increases, right? Since equity increases, so obviously DER ratio increases. So debt more, it can take more debt. Now, less interference, management comfort, because interference is less. Unlike equity shareholder, preference shareholder don't have the voting right. I told you earlier, they don't have the voting right unless the dividend has not been paid for 2 years, right? So they don't get the voting right, and since they don't get the voting right, so preference shareholder, so management retain full control of the decision making, and also no security is required. Means unlike loan or debenture which require collateral, companies raise preference capital without pledging any asset. So final thought, should companies use preference capital? Preference capital is like a low risk alternative to the loan, right? It's like low risk alternative to the loan, offering stability without risk ownership. But remember, it's not tax friendly, and dividend can't be avoided forever. So company need to find the right balance between equity, debt and preference capital for sustainable growth. Let's talk about the drawback also. What are the drawback of preference capital? So we have just discussed why companies raise preference capital and its benefit, but is it always a great choice? Let's uncover the drawback of the preference capital, right? So what are the drawback? That we know preference capital provide easy funding with limited interference. Why limited interference? Because no voting right is there, and funding is also easy, but there is no such thing as a perfect financial option. Here, let's see what are the drawback of preference capital. Management interference. What it means? Sometimes normally preference shareholder don't have voting right, but if a company skipped dividend payment for over 2 years, so suppose company did not pay the dividend for over 2 years, then what happened? The preference shareholder gain voting right. This means they can influence company decision, which the management might not like. And there is another disadvantage, is that non-deductible dividend, which means that unlike loan interest which reduce tax liability, dividend on preference share are paid from the post-tax profit. So this increase the real cost of funding for the company. I told you earlier, suppose post tax profit of the company is 1 lakh, and it pays rupees 10,000 as dividend. So this 10,000 which it pays, it cannot avoid, it cannot take rebate on it. It has to pay tax on the entire amount, right? That is a part. So it is paying tax on the entire amount also, and some part of that PAT, that profit after tax, it is giving to the dividend, it is giving to the shareholder. So it means that it increases the cost for the company. There is no saving for the company. And there is such a hidden cost which is called redemption reserve. This is the hidden cost. When company issue redeemable preference share, they must set aside money. Preference share has a two part, redeemable and cumulative. So when a company issue redeemable preference share, they must set aside money to repay investor later. This lower retained earning, affecting long-term capital planning. Obviously, because they have to set aside some part, right? And there is something called equity shareholder discontent. Equity shareholder might feel left out because preference shareholder get priority dividend before them. This can create dissatisfaction among common shareholder. And they have the priority in the liquidation. This is one of the disadvantage also. Why? Because if a company shut down, preference shareholder get their money before equity shareholder. This means common shareholder may end up with nothing if there are not enough fund left. And there is something called uncertainty due to voting right. So if a company the fact that preference shareholder might suddenly gain voting right create uncertainty for management. Imagine running a company and not knowing who may have a say in the future decision. So friends, that's all about our first part of the video. We will cover the next part in the upcoming lecture. We will talk about the term loan in detail. I hope you like the lecture. Feel free to WhatsApp me on this particular number if you want more such videos. This is the number which you can WhatsApp me on, 8292857381. So let's just after this video just move to the second part of the video. Thank you.